Welcome back to the Daily Crypto Deep Dive. Bitcoin sitting near all-time highs while most altcoins feel lifeless is not a glitch in the market. It's not manipulation. And it's not proof that crypto is broken. It's a signal. And once you understand what that signal is telling you, the entire market suddenly makes a lot more sense. To really understand what's happening right now, you have to forget how previous crypto cycles worked. This cycle is structurally different. And if you try to apply old mental models to it, everything looks confusing. In past bull markets, capital usually entered crypto through altcoins. Retail investors chased narratives, small caps exploded, and only later did Bitcoin reassert dominance. This time, the order has flipped completely. Capital is entering crypto through Bitcoin first, and in many cases, through Bitcoin only. That single change explains most of the divergence you're seeing. The most obvious driver is institutional money. Bitcoin now has spot ETFs. That sounds boring, but it is revolutionary. For the first time, large pools of capital can buy Bitcoin exposure without touching an exchange, without managing private keys, and without any operational complexity. Pension funds, asset managers, family offices, and advisors can allocate to Bitcoin in the same way they allocate to gold or equities. When that money comes in, it does not trickle. It does not rotate. It does not experiment. It goes straight into Bitcoin. This creates a powerful imbalance. Bitcoin is being bid relentlessly by long-term, slow-moving capital. Altcoins are left competing for what remains, which is mostly retail liquidity and speculative flow. There's another layer to this that doesn't get talked about enough, and it's the role of where capital feels safe expressing conviction. Institutions don't just think in terms of upside, they think in terms of exit. Bitcoin offers something altcoins simply cannot right now: certainty of liquidity under stress. Large funds know that if conditions deteriorate, Bitcoin will still trade, spreads will still be tight, and there will still be buyers. That matters more than potential upside in uncertain environments. Altcoins, even large ones, don't offer that same guarantee. Liquidity can vanish quickly, spreads can widen dramatically, and exits can become painful. So even when institutions believe in the long-term future of blockchain more broadly, they express that belief through Bitcoin first, because it is the only asset that behaves predictably when conditions change. This also explains why Ethereum, despite its size and importance, has struggled to outperform Bitcoin meaningfully. Without the same ETF-driven inflows, and without the same narrative clarity, Ethereum sits in an uncomfortable middle ground. Too big to be speculative, not yet clean enough to be defensive. Many altcoins sit even further out on that spectrum, where the upside case exists, but the downside scenarios are simply too messy to justify large allocations. In practical terms, that means capital waits. And while that capital waits, time itself becomes a pressure. Tokens unlock, teams sell, early investors rotate, projects burn runway. None of that happens to Bitcoin. Bitcoin doesn't need to fund development. It doesn't need marketing. It doesn't need narrative maintenance. It simply exists. That asymmetry compounds over time. The longer capital stays parked in Bitcoin, the more stressed the altcoin market becomes, and the more dramatic any eventual rotation will have to be to matter at all. That alone is enough to keep Bitcoin strong while altcoins stagnate. But it goes deeper than that. Bitcoin's identity has changed. In the eyes of large capital, Bitcoin is no longer viewed as a tech experiment or a high-risk bet. It is increasingly treated as a macro asset, something that responds to inflation, monetary policy, and global liquidity conditions. Something that can sit in a portfolio alongside gold, bonds, and equities. Altcoins do not have that status. Altcoins are still seen as venture-style investments. They carry protocol risk, regulatory risk, governance risk, founder risk, and liquidity risk. In a world where interest rates are still elevated and macro uncertainty hasn't gone away, capital is selective. It wants asymmetric upside with minimal existential risk. Bitcoin fits that description far better than almost any altcoin. So while Bitcoin is being accumulated, altcoins are being evaluated, delayed, or ignored. Another major factor is supply. Bitcoin's supply is fixed, predictable, and now tighter after the halving. Every dollar that enters Bitcoin has a relatively direct impact on price. There are no surprise unlocks, no team allocations vesting, no foundation wallets dumping into strength. Supply dynamics are clean. Altcoins, by contrast, are drowning in supply. Many projects have massive, fully diluted valuations that were justified during a zero-rate, high-liquidity environment, but look absurd under today's conditions. Tokens unlock monthly. Teams sell to fund operations. Early investors take profits. Even strong projects face constant sell pressure simply to stay alive. This creates a brutal structural disadvantage. Even if money flows into altcoins, it is constantly offset by new supply hitting the market. That keeps prices suppressed and charts looking dead. Liquidity concentration makes this worse. In this cycle, liquidity is not spreading evenly across the market. It is concentrating. Bitcoin holds the deepest liquidity. Ethereum holds some. A handful of large-cap altcoins get occasional attention. Everything else starves. This is how professional capital behaves. Market makers, funds, and institutions need depth. They need to enter and exit without blowing out the price. Bitcoin offers that. Most altcoins do not. So liquidity begets liquidity. Bitcoin gets stronger. Alts get weaker. And once liquidity leaves an altcoin, it is incredibly hard to bring it back without a powerful narrative or a sudden rotation. There is also a psychological layer that people consistently underestimate. Retail investors are traumatized. The last cycle was brutal. Many people bought altcoins near the top, watched them collapse 80 to 95%, and then held them all the way down. Even now, as Bitcoin approaches all-time highs, there is deep hesitation to rotate into alts. People are waiting for confirmation. They want to see altcoins move before they commit. But here's the trap. Altcoins never give confirmation first. They move violently and suddenly, and by the time they feel safe, most of the move is already over. The collective hesitation you see right now is part of why altcoins look dead. No one wants to be early again. Everyone wants to be late but safe. Markets don't reward that. Regulation also plays a major role. Bitcoin has clarity. It is widely accepted as a commodity. Ethereum mostly has clarity. Many altcoins do not. Institutions do not want exposure to assets that could be reclassified, restricted, or delisted. That regulatory overhang keeps capital sidelined even when valuations look attractive. This is why narratives like utility aren't rescuing altcoins. Utility does not matter if capital cannot flow freely. Markets are driven by liquidity first and fundamentals later. Until regulatory risk clears, many altcoins remain uninvestable for serious money. Now here's the part most people misunderstand. Altcoins are not dead. They are dormant. Historically, altcoins do not perform when Bitcoin is discovering price or hovering near highs. They perform after Bitcoin establishes a clear range and capital starts hunting for higher beta. That phase has not arrived yet. Right now, Bitcoin is still the trade. It is absorbing inflows. It is consolidating strength. It is setting the foundation. Only once Bitcoin dominance peaks and capital feels comfortable rotating will altcoins get their moment. And when that moment comes, it will not be gradual. Altcoin rotations are violent, selective, and short-lived. A small number of projects will explode. Many will barely move. And a large percentage will never recover at all. This cycle is not about broad altcoin seasons. It is about brutal selection. Another uncomfortable truth is that many altcoins deserve to look dead. Projects launched with unrealistic valuations, weak revenue models, and vague roadmaps are being exposed. The market is no longer forgiving. Capital is no longer free. Survival now matters. Bitcoin thriving while altcoins struggle is the market doing its job. It is filtering. It is concentrating value. It is forcing differentiation. So when you ask why Bitcoin is near all-time highs while most altcoins feel finished, the answer is not one thing. It's a convergence of forces. Institutional capital enters through Bitcoin ETFs, not altcoins. Bitcoin is treated as a macro asset. Altcoins are treated as venture risk. Bitcoin has clean supply. Altcoins are diluted and inflationary. Liquidity is concentrating, not rotating. Retail is cautious, traumatized, and waiting too long. Regulatory clarity favors Bitcoin over everything else. This is not the end of the cycle. It is the Bitcoin phase of the cycle. The altcoin phase, if it comes, will feel completely different. It will arrive when people are bored, frustrated, and convinced it's not coming. It will reward those who positioned early and punish those who waited for certainty. That's why this period feels uncomfortable. It's supposed to. Bitcoin being strong while altcoins look weak is not bearish, it's transitional. It's the market building a base before it decides where risk goes next. And whether altcoins explode or quietly fade away from here will depend on one thing above all else: when capital decides it's safe to stop hiding in Bitcoin. Until then, this is exactly what the market looks like. Drop your thoughts in the comments, and as always, we will see you at the top.